Hello. Let's talk about employer and employee paid obligations. Taxes are a part of conducting business, and whether taxes are income or employee related, a business must abide by the applicable regulations for the timely submission and reporting of taxes. Employers have responsibilities for collecting federal income tax, Social Security, and Medicare taxes from their employees. But in addition, the company is responsible for federal and state, where applicable, unemployment taxes, as well as liable for collecting, reporting, and submission of those taxes. Employers also file year-end forms and submit them to the tax authorities and agencies. It's important for payroll accounts to understand the connection between the Form W-2 and the final paycheck of the year. All the tax filings and payments must match, or the business will receive tax notices asking the business to correct the filings. Have you ever received a corrected Form W-2 from an employer? That is often one of those circumstances where the payroll information did not match the quarterly and annual tax filings, and the employer had to correct the annual forms to match the payroll information. In this video, we'll learn about employer-paid and employee-paid obligations and what payroll accountants must do to ensure compliance. Let's look more closely at employer-paid and employee-paid obligations and who is responsible for what portion. The employer-paid payroll taxes are legally mandated or statutory deductions. The table here shows us who pays what deductions. In some instances, both the employer and the employee pay, like, for instance, Social Security, Medicare taxes, local occupational taxes where applicable, and 401k deductions. Income taxes such as federal, state, and local income taxes, as well as other voluntary deductions, are only paid by the employee, and FUTA, SUTA, with some exceptions, and workers' compensation insurance are paid only by the employer. Regardless of who is responsible for the taxes and deductions, once a firm agrees to become an employer and the paychecks are written, the employer must reconcile employee tax withholdings with tax payments on quarterly and annual forms. Even after an employee is terminated, the tax responsibility often continues, depending on when the employee stopped working and the circumstances surrounding the termination. For example, if an employee resigns, then the employer needs to pay the employee his or her final amounts due, while the appropriate quarterly reports and issue the Form W-2 at year end. If the employer granted stock options or restricted stock to the employee, the reporting responsibilities continue even many years after the employee left the company. So how does it all work? We'll look first at FICA taxes and specifically the employer responsibility. We discussed that the employer and the employee both share responsibility for FICA taxes. For these taxes, the employer matches the amount withheld from the employee's pay. Remember that the employee has 6.2% withheld for the Social Security tax and 1.45% for the Medicare tax. Employers must pay these amounts in addition to the employee's wage or salary. However, only the employee is responsible for the Medicare surcharge if they earn over the maximum wage amount according to the provisions of the Affordable Care Act. So here's an example of calculating the FICA tax liability. In this example, Russo works as an hourly worker who earns an annual salary of $36,000 and is paid biweekly. Her gross pay is $1,384.62 per pay period, which is $36,000 per year divided by 26 pay periods. Russo's share of the Social Security is $1,384.62 times 6.2%, or $85.85. For employer share of the Social Security tax is the same, $85.85, for a total Social Security tax liability of $171.70. Russo's share of the Medicare tax is $1,384.62 times 1.45% or $20.08. Her employer's share of the Medicare tax is the same, $20.08, for a total Medicare tax liability for Russo's pay of $40.16, which brings the total FICA responsibility from Russo's pay this period to $211.86. Employers are also responsible for unemployment taxes, which includes FUTA under the Federal Unemployment Tax Act, as well as SUTA under the State Unemployment Tax Act. FUTA covers the administrative expenses of administering the program, whereas SUTA covers the actual unemployment benefit payments to employees who are unemployed. Federal unemployment taxes is only assessed on the first $7,000 of an employee's wage. And once the employee earns $7,000, then the tax is no longer assessed for the remainder of the year. It's important to keep track of each employee's year-to-date earnings so that the accurate amount of FUTA is remitted. Many states use the same maximum wage threshold. However, there are quite a few states that have higher wage thresholds. The FUTA tax rate is 6%, but employers may receive a 5.4% reduction if they make all SUTA deposits in full and on time, and if they're not in a credit reduction state. A credit reduction occurs when a state takes loans from the federal government to meet their unemployment insurance obligations. So it's important to know that the SUTA tax rate varies among companies, and it's based on employee turnover and layoffs. Payroll accounts are typically responsible for reviewing the unemployment forms that are sent by the unemployment tax agency to the employer after a former employee files for unemployment benefits. So here's an example. Snowborn Inc. is a company based in Great Falls, Montana. The company has 178 employees, all of whom earned more than $7,000 in wages and salaries. At the end of the year, only 145 remained with the company. So how do we calculate the tax liability? First, we know that all employees earn more than the maximum wage threshold of $7,000. That is why we don't even have to look at how much each employee earned, because we already know it's over $7,000. And only the first $7,000 are subject to unemployment taxes. Also, it doesn't matter if or when employees left the company. Taxes is assessed on all employees. So in this case, we multiply 178 employees times $7,000 times 0.6%, which is the full tax rate of 6%, less the state reduction of 5.4%, for a total FUTA tax of $7,476. Now, what happens when there are employees who earned less than $7,000? We would multiply the number of employees who earn more than $7,000 by 7,000 and add the wages for those who earned less than 7,000. State unemployment taxes, or SUTA, are based on employee retention and other factors. Employers with a low turnover rate have a lower rate than those employers that have a high turnover rate. The guideline for SUTA is 5.4%, but this limit may be equal to or higher or lower for the employer. An employer's SUTA tax rate is determined by a mix of state unemployment rates and company experience ratings. The SUTA rate for Company A may be different from the rate for Company B. For example, a construction company may experience higher unemployment claims because of the seasonal nature and higher risk associated with the industry. Therefore, the company's rate may be 4.54%, whereas a similar sized company in a professional services industry may have an unemployment rate of 3.28%. States issue letters on an annual basis to companies with the individually determined SUTA rate for the following year. California's wage base for SUTA taxes is $7,000, and the minimum and maximum rates are 1.5 to 6.2%. Some tips for minimizing SUTA taxes are to know how the rating system works and to regularly review the company's SUTA account. However, employers should carefully select new employees to avoid high turnover. When an employee leaves or employment is terminated by the employer, employers should review employee separation documentation and contest unemployment claims if applicable. In addition, the employer should ensure that SUTA tax is paid timely. But these are only a few tips. Your textbook lists a few additional tips. Workers' compensation insurance is another type of employer payroll responsibility. It's not considered a tax, though. However, states enforce workers' compensation statutes, and federal employees are protected by the Federal Employment Compensation Act. Workers' compensation is an insurance policy maintained by the employer, and premiums vary based on the employee's job classification and the risk of injury they typically encounter in the normal course of work.